Hello, Oakbloke here, and this is covering an article I wrote. It's about a week ago, actually. Just didn't record a video at the time. Not sure why, but anyway, this is my Substack, which is theoakbloke.substack.com, as you can see up there in the top left. So this article covers Thungela, and that's the subject of this video. So it was specifically around the first half 2025, 1H25 results, and yeah, the gist of this is that profits are down 80%, which on the face of it you'd say, well, gosh, that's really poor, really terrible. Earnings per share was 8p, and this is a share that at the moment is £4. So 8p earnings in on a £4 share, 16p a year. So that's kind of 4%. So that's, it's not great, is it? But if you look at the historical earnings, it of course paints a very different picture. If we take a look at the history of this, because quickly it floated, it was actually divested from Anglo American back in 2020, I think it was, and on the back of rising coal prices after the invasion of Ukraine, of course the share price leapt up by a great deal, and since then has been dropping. So it's about 3/4 down from where it stood back when coal prices were much higher than today. And if we look at coal prices explain an awful lot of the problems with this share. And if we look at coal prices, being coal prices here, that we can see during the first half, which is this period from here. So it started at 113 and ended at 111. But for all of that period in between, in the first half, you can see coal prices dropped to as low as whatever number that is there, which is about 90, dropped down to about $90. And of course, because coal's not an exact science, so you earn based upon the calorific value, you earn based upon the amount of pollutants in the coal. The South African coal was earning much less than the headline figure of about 90. So you can see weak prices explain a lot of the first half results, and we can see coal prices dramatically rose after the invasion of Ukraine, but have come back down again as well, or normalized, perhaps is perhaps the way to explain it. Where will they go from here? Well, the current coal price is back to about 113, so much higher than it was in the first half. Well, much higher, but it is higher than the first half. And I would say the outlook in the second half is looks pretty robust. You can see here China experienced a surge in coal power projects. There's a number of countries that are taking coal production offline, and so there's reasons to think that coal will be better supported in the second half. So as I say, profits down, but will we see reignition in the second half? Well, I mean, the first thing to say about this share is that if you look at the balance sheet, so the balance sheet would show you that you've got £4.58 of liquid assets being cash and equivalent. And if you strip out the payables or the liabilities, current liabilities, then that nets off to £2.61 a share. And as I say, that's well, at the time I wrote the article, it was at £3.61. Today it's at £4. So for a net £1.40, I guess you could say, on today's price, well, there's £1.10 worth of coal inventory for a start. So then that sort of means you're paying a net 30p a share for £4.12 of net assets, net of all other liabilities. So from an asset point of view, incredibly cheap at its current price. I mean, I say here it was thrown in for free. It was at the time when I wrote the article. It's bounced about 10% in the last week or so. I think people have realised that it's priced at silly levels, and it's bounced back up a little bit, but certainly nowhere approaching fair value, as you can see here. I mean, on the basis here, it's at about a 50% discount, so 7.96. If it's at £4, it's just under 50% discount. Thungela has some of the lowest coal production costs, not the lowest, but the places that have the lowest are in places like Russia and are subject to sanctions. And of course, Russia is also under sanction in terms of equipment and capital purchases and replenishing machinery and so on. So can only buy that from places like China, not from the West. So potentially the Russian coal miners, whilst they are very low on the cost curve, the problem that they've got is that they're subject to struggling to sell their coal, and obviously selling coal. You either do it seaborne, you put it on a ship and float it somewhere, or you can deliver it somewhere. But the further you deliver it, the more expense is involved. The cost of shipping it thousands of miles is very, very marginally profitable. So if you've got the lowest production in the world, but all of your local markets have shunned you because of military conflict that you've initiated, then and you've got to sell your coal to China, which is thousands of miles of distance, and yeah, there's just all sorts of logistics problems involved in that. So you can see the Thungela are the red stripes. So mainly, a few in the first quartile of cost, mainly in the second quartile of cost, with one of them in the fourth quartile. And this is one that is nearing end of life, so we'll be dropping off. And in terms of where Thungela invest, so their first priority is safety. Their second priority is to invest back into their production to reduce operating cost. They want to drive that down if they can, and that investing back in competes with shareholder returns. So they kind of talk of, if a project can deliver a substantial return on investment, they'll do it. If it can't, they'll return the money. And historically, they've returned a great deal of money to investors. This article, which I wrote about a month ago, was my first article on, and it was back when it was £3.59. So it sort of has gone up, gone down, gone up. But in this article, the shareholder returns are tremendous. I think we can see it. Let's see. It's just very, very substantial returns back to shareholders over the course of its life. And also that if you look at coal demand is not reducing. It's reducing potentially as a share of energy, but not reducing in absolute terms. In other words, there is actually more terawatts worth of coal being burnt and will be burnt or forecast to be burnt for years to come, just because there are developing nations that want to get themselves out of poverty and need energy to do so. And whilst, yes, they can invest into solar and wind and other technologies and are doing that, they still need baseload power, and coal is a way of doing that, a way of achieving that, particularly India, but also places like China, that their need for energy is so great that coal fills part of that void. So you can see the returns were 826 million. So that's kind of twice the share price. So phenomenal returns that have been made, and part of that was down to the spike of coal prices that obviously they were printing money at one stage, and who knows, maybe coal prices will return there, maybe they won't, but certainly at the $90 mark where it dropped to in the first half of 2025, there were coal mines that were basically not making any money, that were being taken out of production because it's not worth carrying on with them. Some in Colombia, some in Indonesia, and so on. So the next thing I'll talk about is that as well as having 6 mines in South Africa, they've bought a mine in Australia, so they've got an Australian project as well. They also own a coal processing plant. So when you dig coal out of the mine, out of the ground, you need to dry it off, you need to process it. You can't just chuck it straight into a blast furnace or straight into a power generation plant. You've got to process it before. I don't know much more than that, but a coal processing plant is the necessary step in processing the coal ready for use. And Thungela also have 23% of the coal terminal. So the Richards Bay coal terminal, which is on the eastern coast, the Indian Ocean coast of South Africa, is one of the leading coal export terminals in the world. And so yeah, they've got their fingers across a number of pies, and that shows you the production in South Africa and in Ensham. So majority of productions in South Africa, the Ensham, they part owned it, they now fully own it. So that's their coal mining. Now, in the first half, it wasn't just about low prices; they also had heavy rains, and there's a number of other companies that I've spoken about. Thungela is another example of an open pit, South African based, that had disrupted production in the first half of 2025. So, production down by 20% due to heavy rain. Not great. That applies to the open cast projects, and that had an impact on production. So you can kind of see how much impact different things had. So pricing reduced revenue by about 1.3 billion. Foreign exchange, so adverse foreign exchange, by 0.3. Volumes were actually up from South Africa despite the open pit flooding, and and obviously that's the reason for this imaginary picture of flooded open pit coal mine. It's not real; it's just imagined. And then this is the Australian project, Ensham, and Ensham had some geological challenges with its production as well, which again they now feel they've resolved in the second half. So and then there was some impact as well on domestic sales of coal, which again is marginally profitable. So this revenue doesn't make much impact, but it's a large part of it is the impact of a lower price combined with some disruption to quantity as well. But a lot of these things were temporary factors that aren't happening now, arguably. So what we can see is that coal has increased since the 30th of June. So obviously I've just flashed that chart up. So this is the chart as it stood. So we can sort of see about a 14% increase on prices. So far this half, we can see that the another reason that South Africa had challenges historically, and how the share price dropped 75% was due to problems with the inability to get the coal to the coal terminal. So rail performance and derailments and problems with the railway was another reason that this fell in price. So what we see is in the first half of 2025 a further improvement in rail performance. The railway is not an asset that Thungela own, but it's a subcontractor or a supplier that it uses to get its coal from A to B. So the fact that this has improved is positive for Thungela. So we can see that Thungela are working on a couple of capex projects. So these are both essentially life extensions to extend production by a further period of time. So you've got Elders in South Africa that will be generating 4 million tonnes per annum from next year, so early next year, and Zibolo, which again is due to complete next year, will extend 8 million tons of production. So it's a safeguarding and a reduction of operating cost rather than, they're not developing new mining projects, new coal mines, but they're extending the life and cost efficiency of two of its existing. And to be fair, this one, Elders, is a replacement for Gouda Hoop, which comes offline. It's at the end of its life, but Elders is kind of a part of that part, sort of adjacent to it or something. So that's all positive. This is the future demand, according to the I think this is Wood Mackenzie, but the IEA give similar numbers. So we can see in absolute terms, the share, whilst the share percentage will go down, the absolute terms goes up. And this was numbers that they provided in 2020, but the same numbers exist. I think this percentage is now looking more like 20, 28, 29%, but this number is now larger than what they thought it would be back in 2020. So robust demand is a positive. Discount is a positive. The reserves that it has are a positive. So it's got 7 years of reserves, as in proven resource, but then they have resources, 38 years of resources, which could in part or in full be converted into reserves. So essentially by testing the ground, by doing test drilling and so on, as you would with any other mineral, you can prove out your resource from a resource to a reserve, essentially. So in terms of cost, I mean, they're producing at about 51 £51 a ton. In Australia, it's more like 63. But then when you consider that the Australians sell at the Newcastle price, whereas the South Africans discount by about 15%, the cost of production, or at least the margin across two countries is about the same. And whether you discount off the revenue or you add the discount as part of the cost of sale, I prefer to add it back in as a part of a cost of sale. So you kind of get to about £63 cost in each country, essentially, by factoring in the discount of price. And it's a discount of price because the calorific value is slightly lower in South Africa, the coal coming out of South Africa, but also the pollutants are slightly higher, so they get money knocked off when there's too much sulfur or too much other sort of pollutants. So what you kind of see is at a reference price of about £80, which would be about 105, £106, oh sorry, $106 rather, that you can sort of see there's about a £5.94. So for it to go slightly above that to above 110, and obviously the FX rate, I'm using 136, which I think's about right for today. But you can see there's not necessarily vast margins, but even with this margin of 594, you're looking at a margin across the business of about 100 million on a share that you can buy for 500 million. So it's a price earnings of 5 times, even when the price of coal's quite low. So it's a if you map out the reserves, you can come to a figure approaching 1.4 billion pounds. Obviously that you could need to discount that out to obviously get that's not necessarily implying that it should be triple the share price, but that's based purely on the resources that it has. If you add in the reserves, you get to a much higher number. And yes, whilst coal dropped, following Liberation Day, this is I think sort of reiterating here, but that sort of explains it. Coal consumption. So this is the IEA showing that coal consumption is actually forecast to grow, and the forecast to grow is China, India, and ASEAN are the reasons for increases, offset slightly by some decreases in rest of world, European Union, and United States. So what we also see is that there's this is increase of supply. So again, India is potentially increasing its supply according to the IEA, but what we can see is all of these places that are reducing their supply. So Indonesia is the green, and so on. So a lot of reduction of supply combined with increasing demand just makes this um, an idea that has strong fundamentals. And if you look at Reuters spoke very recently about how the Russian businesses are struggling. With well, in fact, 30 of them are at risk of bankruptcy. The Russian government have stepped in to support the struggling coal industry, deferring tax payments. So lot of challenges there that would be a disruptor to supply as well. And I think Russia is something like 10% of the world supply, so it's quite a substantial hit if 30 sets of Russian coal miners go out of business, or even if just a share of them go out of business. There's also the idea that coal can be used for the generation of things other than just burning it to make electricity or burning it to provide heat. The fact is that the Chinese are doing an awful lot of work into using coal to create synthesis gas that can then be used for all the things that you would use natural gas for. So rather than using natural gas, to use coal instead, on the basis that China doesn't have vast amounts of natural gas, it has to import it, and it's a strategic resource that it would rather not have to import if it could help it. So we also have a lot of work being done in China around net zero coal. Again, it's carbon capture projects that are the most advanced in China of all the places. You'd probably be a little bit surprised by that. It's also the case that Thungela have a natural gas, so it's coal bed methane. So it's not natural gas as in a gas well, but it's a coal seam that has methane emitting from it, and that they could potentially capture that and gas in place. 3.5 trillion cubic feet is a substantial amount of gas, no two ways about it. I mean, whether all of that would be recoverable, I mean, they talk about the contingent resource being between 0.7 and 1.56 trillion cubic feet. So, probably only a quarter to a half is recoverable, but nowhere is that in the price. And if you took a $3.50 per MMBTU and converted that, I mean, you're looking at, that alone is at that price point, and using that level, the quarter, 25% is recoverable. You're looking at 1.87 billion of revenue. If the cost of production and transportation of that swallowed up 90% of the revenue of that revenue there, I mean, you're still looking at 187 million of gross profit or EBITDA profit. Nowhere is that in the price. It is early doors and it's not certain, and it's up here in northern South Africa, but it's a couple of hundred miles, a couple of hundred kilometers from Pretoria and Johannesburg, which are kind of about here in South Africa. So could they hook it in to supply the capital? Possibly. Up here is Botswana. So again, where this is located isn't necessarily in the middle of large populations, but there's some potential there. And just kind of a couple of other things. So the operational guidance going forwards was that production will be stronger, pricing potentially stronger. That if we look at this was the first half actuals, so we can see here the 10 million of profit, but applying these operational guidances to the second half results, and just sort of following the lower or slightly above the lower reference mark, and applying current prices, applying the same cost structure, with a slightly lower cost structure on Australia. And the reason for that was that that the disruption in the first half had an impact into the cost. So I think that's a fair assumption to be making. That where we see that ending up is a net profit that increases by 7.5 times compared to the first half. So a full year result of 85, and if you were happy enough to say, well, that is repeatable into the first half of next year, I mean, 150 million net profit run rate on a share, as I said, that's costing just over 500 million. I mean, you're looking at what, three and a third times, 3.4 times earnings. So incredibly cheap, and you can kind of see how this could go up in price. That £4 is fundamentally very cheap for it, and also that when you consider that reducing supply and increasing demand are reasons that this is almost a baseline profit rather than a sort of likely outcome. This is almost quite pessimistic, assuming that these current day rates are going to be the definitive rates, plus no value assigned into the coal bed methane, into other things as well. So just to conclude, then I would say, if things don't continue to recover and coal were to drop again, all that would do, I mean, Thungela's got quite deep pockets. We can see that they've got vast amounts of cash, that they would weather the storm, and other competitors would drop out of the market, and they would increase their dominance, as far as I can see. So lots of reasons to feel positive about the prospects for Thungela. And yeah, that probably summarizes this video. None of this is advice. It's just me talking through my own personal opinions. I'm not connected to Thungela or any company I talk about, so I'm just speaking in the capacity of a private investor, and you make your own investment decisions. But anyway, that's the Oak Bloke signing off. Cheerio for now. Cheerio.